Wealth After 50 presents, Is Gold a Good Investment Now? I found this really interesting breakdown of whether gold is actually a smart move in 2025, or if we're all just getting caught up in the hype. I wanted to walk you through it because it had some points I hadn't considered. Okay, so first, why does everyone even care about gold? The classic sales pitch, as this article laid it out, is that it's supposed to be your shield against inflation and market crashes. It's the asset that's meant to go up when everything else is going down. And the numbers right now look pretty convincing. Spot gold has climbed, getting close to $3,630 an ounce. A lot of gold supporters will tell you that if you had put $10,000 into gold back in the year 2000, it would be worth about $117,000 today. That's a return of almost 11% a year, which sounds great. But then the article showed the other side of the coin. That same 10 grand invested in the S&P 500 would be worth nearly $460,000. So, while gold did beat inflation over that 25-year period, it definitely wasn't the best place for growth. Get this, between 1980 and 2000, gold's value actually dropped by 70% after you account for inflation. The takeaway here seemed to be that gold can protect your money, but its timing is everything. Next, it dug into the safe haven idea, the belief that gold will save you in a crash. The data here was pretty surprising. During the 2008 financial crisis, gold actually dropped 30% at first before it eventually recovered and finished with gains. When the pandemic hit in March 2020, it fell 12% in about a week. And even in the mini bank scare we had in April 2025, which pushed gold over $3,600, it was still super volatile. The conclusion I drew from this is that gold can work like a parachute in a crisis, but you have to be prepared for it to have a few holes on the way down. This section was about something called opportunity cost, which is basically the gains you miss out on by choosing one investment over another. Since 2000, gold's real return after inflation has been about 8%. U.S. large-cap stocks were at 6.8%, but small-cap stocks were at 8.5%. And here's the key difference the article pointed out. Those stocks were also paying out dividends that whole time, which gold doesn't. Missing out on even 1 or 2% in returns each year can add up to a massive difference over a 40-year career. Now, I'm more of a long-term investor, but there was a section for traders that was pretty eye-opening. For someone trading day-to-day, gold can be volatile. It swings about 1.5% on normal news and can jump 3% if the dollar moves unexpectedly. Because so many people trade it, the patterns are apparently pretty clear for technical analysis. But there are catches. The article warns about the costs of certain ETFs and the fact that gold trades 23 hours a day, so it can make moves while you're asleep. It sounds like a playground for pros, but a risky one for beginners. So, if you decide you do want some gold, how do you actually own it? First, physical gold like coins or bars. The upside is it's all yours, with no third-party risk. The downside is you pay a premium when you buy and sell, and you have to figure out how to store it securely. Second, you can buy ETFs like GLD or IAU. This is way easier, and you can sell in an instant. The expense ratios are low, around 0.25%, but you are trusting a custodian to actually hold the gold for you. Third, you could invest in gold miners. This gives you leverage exposure. If gold goes up, miners can go up even more. But you're also taking on risks like management mistakes, environmental issues, or worker strikes. The big idea isn't to become a gold evangelist, but to think about it as a small piece of a bigger puzzle. Modern thinking suggests a much smaller slice, maybe 5 to 10%, can help reduce your portfolio's overall risk without sacrificing too much growth. JP Morgan's forecast at the time of this video puts gold around $3,670 by the end of the year, with a potential to hit $4,000 in 2026. But they also see a potential floor around $3,000. It's best treated like insurance. Have enough to help you sleep at night, but not so much that it stops you from buying assets that actually grow. So, after reading all of this, what's the final verdict? For a long-term investor, gold's real purpose is to have a small portion of your wealth completely outside of the traditional banking system. For a trader, the volatility is there to be played with, as long as you're careful. And for anyone who's just generally worried about the state of the world, a small 5% allocation can soften the blow during downturns and feel like a safety net. But if you're really looking for those big, compounding returns year after year, history seems pretty clear. You're probably better off just buying an index fund and enjoying your life. And remember, it's never too late to grow your wealth after 50.